All right, folks, and welcome to the introduction lecture to alpha stocks. If you ever wonder how to identify and find stocks that outperform the market, then this is going to be a great introduction. We're going to explore characteristics of alpha stocks and how do you search and screen for them. So if you're new to our YouTube channel, don't forget to subscribe and hit the notification button so that you're one of the first to receive an email alert once we upload lectures like this. So with that being said, let's get right to our content that will help you better become more familiar with alpha stocks. What is an alpha stocks, right? There's different terminology, there's different descriptions to identify or describe stocks that are leading and outperforming the market. Some of you might have heard of monster stocks. I like to call them alpha stocks because these are the stocks that are generating above market returns in your portfolio. And I've laid out a few examples here. So when you're looking at alpha stocks, these are stocks that are going to double, triple, or even quadruple in a very short period of time. I'm talking about 6, 12, 24 months. And if these are companies that have very strong fundamentals in a new industry, gaining market share, then chances are that this is not only going to last 24 months, it can potentially last 5 or 10 years during the duration of a decade if it's a circular trend in a particular bull market or a segment of an industry within our economy. So I've laid out right here 3 good examples of what alpha stocks are and represent so that we can pay close attention to the characteristics of these stocks. First, we're going to examine the charts. Then we're going to look at the fundamentals, revenue and earnings growth, and try to understand a little bit more of their product and services and the changing consumer behavior that led these stocks to actually outperform the market. So the first company that I'm displaying on my slide is Nvidia. From 2016 to 2018, in about a 24 months period of time, this stock returned 488%. I mean, think about that. 488% in about a 24 months time period. Imagine if you had that in your portfolio. It would have definitely returned above market return if you're comparing it to the S&P 500, and this would have made your entire year or 2 years actually. If you allocate, let's say 10% of your portfolio, 20% of your portfolio, this would really be the kicker to creating superior performance. Now, what are some of the close things to pay attention to when you're looking at companies like this? I've actually included on our slide here. You can see that I am, from a financial standpoint, what are some of the variables or financial data that you should be concerning yourself with? See here how I have sales growth for Nvidia. 2017, 38%. 2018, 41% revenue growth. 2019, 21% revenue growth. Now look at the bottom line, which is earnings per share. 2017 earnings up 137%. 2018 earnings, it was down 84%, so this was probably due to a one-time charge that is not part of the day-to-day operations of the business. But when you look forward to 1 year out, look at the earnings growth, 1,500%. So from a top-line standpoint, superior, above average top-line growth. And on the bottom line, you're also seeing superior, above average earnings growth as well. So when you're looking for some of the characteristics of companies that are going to outperform the overall market, you want to look for growth. Strong revenue growth and strong earnings growth. So that's number one from the financial standpoint. Let's look at another example here. You have Lululemon. Look at the top revenue growth for Lulu, up 14% in 2017. In 2018, 13%. In 2019, 23%. Look at the bottom line earnings, 17% in 2017. 2018, 21%, and then 92% in 2019. Now, the revenue and earnings growth for a company like Lulu may not be as high as a company in the tech space like Nvidia. But here's the kicker. Lululemon was outperforming and operating better than other traditional brick and mortar retail companies that were being disrupted by companies like Amazon, where people were shopping more online, and the traditional brick and mortar business were facing a lot of downward pressure because of the reduction in foot traffic. People staying at home longer, ordering online, it's just convenience. However, in that type of environment, Lulu was actually growing and doing better than other retail companies. So this level of growth was something not seen in the traditional apparel retail space. Therefore, the market would give a premium to Lulu, and the results were the company increasing 221% from 2018 to 2020. Now we're gonna look carefully at these charts so that we can look at the technicals and see where could we have identified a breakout and a potential upside move before it occurred. Also providing that the fundamentals and the growth of the business on the top line and the bottom line are also strong. The third example that I've listed on my slide here is Square. Square from 2017 to 2018, 12 to 24 months, look at the returns. 400% return. Now look at the revenue, top line growth. 2017 was down 47%, okay, but the market is always forward looking, 6 months to 12 months. So just because revenue on the current year might be down, pay close attention to what's gonna happen in the next 12 to 24 months, because it's an indication of how the company's gonna grow the top line, cash flows, earnings, which at the end of the day, as investors, as equity holder, we concern ourselves with the growth of cash and earnings, because as an equity holders, we have claims to the business earnings. So I wanna know how much is my piece of the pie is going to grow by, and that is in the form of earnings per share. So look at revenue the following year, okay? 60% growth. 2019, 43% growth. Then look at the bottom line. Even though revenue declined in 2017, look at earnings for 2017, up 153%. The following year, 2018, up 70%, and then 2019, up 52%. And this was obviously a monster move. But when you pay closer attention to the business model and what was happening, Square is just a payment processing business. You can create an account with Square. They actually give you your own device where you can charge credit cards. You can basically collect payment from customers, and it just makes it a lot easier for entrepreneurs to run their business and collect revenue. So it's just a payment processing type of business application that Square had created. And now with online being more prominent, increase in online web traffic, especially in our current economic situation that we're in right now with the mandate of staying at home due to the coronavirus, that has increased the number of payment being processed online. So it definitely benefits Square. So these are three good examples of what are some of the characteristics from a performance standpoint that alpha stock will possess. So in a very short period of time, you're looking at a stock that will double, triple, 12 to 24 months out. Now let's look carefully here at the chart. Let me pull up my chart. Here it is. And first, let's look at Nvidia. If we zoom out, look at this monster performance. Let's bring this back to where it originally did, and let's actually remove some of these drawings, and I'll address what these drawings are. Okay, but here's the first point that I want to point out. From 2016, okay, you see here 2016, roughly around $35, all the way to 2018, $210. I mean, this is a monster move. Now, this whole move right here, over 400% return. Now the question becomes is how can we identify these stocks before they make their monster run? And that's the overall goal of this webinar. And I'm gonna provide you very specific points to pay attention to from a financial perspective and also from a technical perspective when we are analyzing and looking at the chart that can increase our probability of selecting future stocks that are going to perform like this. So this was on Nvidia. Let's look at Lululemon. Let's move this forward from 2017, okay, to 2018. Look here. Another strong performance, as you can see, and even broke 2018's high and went as high to 220 during 2019. Another major performer, okay? And then lastly, Square. You can see Square from 2017 to the end of 2018 from basically $20 to $100 a share. Again, what are the characteristics? What do we pay attention to from a financial standpoint, but then also when we're looking at the charts? And I'm gonna dive a little bit more deeper into analyzing the stock chart so that you can pay close attention on stocks that are breaking out today in this current market environment that may reflect or possess the same characteristics of an alpha stock. And then you can monitor that. You can do a little more deeper research on it to see if the fundamentals justify much higher prices ahead, like a Square, like a Lulu, and Nvidia, okay? So very important thing to understand or take away from this slide is that when you're looking at alpha stocks, make sure that your top line revenue growth is over at least, personally, 20%. That's my benchmark. Also, the bottom line, earnings per share, should at least be 20% growing year over year. So that's two very important things to take away from this slide. Pay attention to top line revenue growth and pay attention to your bottom line earnings per share growth. In terms of characteristics, how can we be more clear and give you some key points to pay attention to as a checkbox if you create a list to help you identify and maybe filter and screen for these type of stocks? Well, here they are. In the previous slide, we looked at revenue growth, and here I am detailing it. So number one, strong sales growth, ideally 20% or better over a sustained period of time. What do I mean by sustained period of time? 24 months, 3 years, 4 years, 5 years. The longer, the better. Why? Because if you're only coming up with companies that have very short-term revenue growth, it just means that they're only going to a very slow period cycle, and it's one of those stocks that perhaps it's a fad, if I may put it in that perspective, where their business model is only strong for the next 12 months because of current economic environment. It's not something that has legs for the next 5 or 10 years. It's not something that is gradually increasing their market share or a product that 50% of the population may adapt and use, or it doesn't have potential to expand to the international market. Okay, so this is why I'm saying over a sustained period of time, the longer, the better, because now you could play a stock that may have the potential of going up 500% or maybe 800% in a period of 5 to 10 years, and you can play it by buying the dips, okay? Because now you're aware that the fundamentals of the business are strong, it's a new technology, it's a new product, and more businesses are adapting it, and also will consumers. So very important to pay attention to top line revenue growth and make sure that it is for a sustainable period of time. Now, how do you know that? By performing due diligence. If you haven't seen our previous stock webinars or lectures on how to analyze a stock by applying a 3 simple step process of situation overview by performing your due diligence, applying technical skills like a DCF, comparable company analysis, and also doing a very short version of an income statement to determine what the growth is. And lastly, how do you come up with your investment thesis and price target? We covered those 3 points in our stock analysis lecture, which is included in our YouTube channel. So I highly encourage you to watch them if you haven't seen it, okay? Point number 2 is an innovative company with a new product or a new service in a segment of the economy that is growing. Here's an example of that. due to the coronavirus pandemic and people staying at home, that has given rise to the stay-at-home economy. What are some of the companies benefiting from that? Well, one of those companies is Zoom, the video conferencing service. More businesses are now conducting their operations from home. Their employees are working at home. They're utilizing Zoom to do video conferencing with their coworkers and working projects, and just allows them to collaborate and maintain the same level of productivity without having to go to the office and spend money on rent. So Zoom is one of the clear winners of the stay-at-home economy. Another stock that has actually been outperforming due to the pandemic and people staying at home and perhaps not having the ability to go to the hospital is Teladoc Health, where through their application, you can be connected with one of their assistants. It could be a doctor, it could be a specialist. They can diagnose what type of symptoms you have, and they can easily prescribe you the medicine that you need without having to go to the doctor. So you have to pay attention to new companies that are emerging with new product and services in parts of the economy that have momentum and can become a bigger portion of the US economy. So innovation is very important when you're looking at for alpha stocks, okay? Number 3, increase market share. Now, if a company has a strong product or service and the top line revenue growth is actually increasing, that also means that within their industry or their subsegment of the overall economy, they're growing, they're increasing their market share. That means that employers, businesses are adapting the product or service. Consumers are also demanding that product and service. So more people essentially are using it. So is it going to increase their market penetration where 5% of the population will be using it? 10% of the business community are going to adapt their service? Maybe 20%, 30%? That's what I'm referring to, increase market share. So you want to pay close attention to the company's revenue and compare it to the overall size of the industry, and every year see how fast they're growing their revenue and how much that revenue is a percentage of the overall industry sales. That's an increase in market share. And that's something that is very important to also pay attention to when you are identifying and researching potential alpha stocks. Point number 4, this deals directly with the bottom line, like we saw in the previous slide with Nvidia, Lulu, and Square. Earnings per share were growing above 20%. For me, ideally, my benchmark is 20%. Other people might have 10%. Some people may actually be even more selective and have earnings per share growth of 30 or 40%. So it's more art than science, but based on my research and looking at the database of alpha stocks and studying these alpha stocks, the average revenue growth and earnings per share growth on these companies has been at least 20%. So that's my benchmark. It comes from a scientific approach of looking at an observation of over 100 stock that have actually outperformed the market, doubling and tripling in a short period of time. And my conclusion is that revenue and earnings growth should be at least 20% or higher. Okay, so that's where I'm getting this 20% number from. Then you have other. What do I mean by other? By other, I'm talking about other factors that might account in analyzing the business. And that might mean a strong management team. That might mean institutional sponsorship, where big mutual funds like Fidelity, Vanguard have actually acquired some of their shares and they're sponsoring this business, where all their portfolio managers may continue to accumulate shares, therefore increasing a rise in the stock price. Another point that I also look at is the amount of shares outstanding that the stock may have. The lower shares outstanding, the better. Why is that? Because let's say, for example, if a company has 1 billion shares outstanding, do you think it's going to be easier to move the price on a company that has 1 billion shares outstanding than a company that has 10 million shares outstanding? This comes down to the fundamentals of economics, supply and demand. When you have a lot of demand for a product or a particular asset, and there's a limited amount of that product or asset, when there's a high demand, what do you think is going to happen to the price? Well, it's going to go up. It's going to increase. This is why I say the lower amounts of shares the company have, and combine that with strong fundamentals, strong earnings growth, the higher the demand. Therefore, it's going to increase the stock price. So pay also very close attention to the amount of shares outstanding that your alpha stock may have. Another important point to account for is profitability and comparing your company to other players in the industry. Look at the competition. Compare the competition profitability, their EBITDA margins, their gross profit margins, their EBIT margins to your company. Is it higher or is it lower? And lastly, you may also want to look at the product and services. Which one has a superior product? Put yourself in the shoes of the customer and download their application. Do your own due diligence, buy the product, test it, and see what the experience is. You're kind of assuming the role here of an investigator or a journalist when you are doing your due diligence on these companies to see how you react to that experience of the product that the business is producing. And if you like that experience, chances are that hundreds and thousands of consumers, just like yourself, are going to adapt that product. And also maybe the business community as well may adapt that product. So you have to also understand the fundamentals of the company to really recognize what is the driving factor or the driving force that is fueling revenue growth and earnings growth. And it all comes down to performing your due diligence. All right? So very important to pay close attention to these 4 points. And on the others, what I've mentioned with shares outstanding, profitability, margins when comparing to the industry, and also doing your own analysis and putting your shoes in the customer shoes to see the experience when you order their product or service, and you basically just get to see the utility of it. Is it even a good product that other consumers may adapt? So that's all part of assessing and identifying key points and characteristics of potential alpha stocks. Okay? So in the next point, or in our next slide, we're going to talk more about how do you identify these companies? How do you screen and search for them? So I laid out a couple of very basic screen lists so that you can simplify this approach and hopefully have a daily or weekly routine where you can get a basket of stocks, and then you can do a little bit more homework on your own and then just keep narrowing it down to the ones that have the characteristics from revenue and earning size that I've mentioned, and also the product innovative in our new economy, okay? So the first thing that I like to look at, okay, and this is part of my process as well, is number one, large price increase. And large price increase, I'm talking about on a daily basis. Number two, strong jump in volume. So points 1 and 2, when a stock increases by 20 or 30% on an intraday basis or overnight, I may want to put that on my radar. Why? Because institutional capital is flowing into those stocks. And if they're flowing into those stocks, it's because they believe that the outlook over the next 6 to 12 months or even 24 months is positive. They have a lot of research analysts, they have access to a lot of information, and when you're seeing the increase in volume, that means that they're pouring hundreds of millions of dollars behind that stock. They're placing a big bet on the outlook in the future rise of that stock. Now, with volume is essentially the amount of shares traded within that day, the amount of shares that investors accumulated on the day that the stock broke out. And I'm going to share with you how that actually looks. When we look at the graph, it's going to stick out, it's going to be a lot more clear. Personally, I'm a visual person, so I do combine the charts with the fundamentals to give me an extra level of certainty that this has the characteristics of a potential alpha stock. So I'm going to show you what that means when we look at the charts. Now, how do you find them? Well, number one, screen for large price increase on a daily basis. Look over the 52-week high list. Pay close attention to earnings breakout. Now, what are some sources out there where you can find these stocks? Simple. Number one, you can go to Google and type 52-week high list, and it'll take you to the NASDAQ. The NASDAQ also gives you on a daily basis stocks that increase the most that day, percentage gainers. You could also go to Yahoo Finance, and Yahoo Finance gives you a list of stocks that have performed best on that particular day. And me personally, I look for stocks that are up at least 15%, okay? From a price standpoint, I look at stocks over $20 a share. Below $20 a share, I don't concern myself with because it's highly speculative. There's a lot of manipulation going on in there. And also, you want to look at the market cap, at least, for me personally, at least $5 billion. Why do I have those criteria? The reason why I have those criteria is because I want to make sure that these companies have a viable and sound business model where they have revenue and revenue is increasing, where they have an opportunity of becoming profitable, and there's a lot of institutional investors supporting the stock as well because they also believe that they have a good viable business. Below $20 is, again, very speculative. There's a lot of manipulation. There's a lot of companies out there that don't have a strong viable business model, and they're basically increasing or decreasing just on rumors. So the term pump and dump, you get to hear that and see that a lot with stocks that are trading, below $10. These are known as penny stocks. So I try to stay away from that world and that game. Highly speculative. There's a lot more trading strategies that you can apply to trade those names. But again, you just have to be aware of the dangers of trading very speculative stocks when they are in the single digits. And look, you really don't need to be in that place when you have good viable companies that can outperform the market, and you also have institutional sponsorship where they're pouring hundreds of millions, if not billions of dollars. Follow the money, okay? I mean, this is why I have it up here. Follow the smart institutional money. They leave footprints. And when I pull up the stock chart, I'm gonna show you what I mean by leaving footprints and how I identify it. So the main takeaway from here is, how do you find these stocks? Number one, search for on a daily basis stocks that have the highest price increase or the highest percent gainers. Number two, make sure that volume is also increasing. Ideally, it's up 100, 200% from its average. Also, you can identify these stocks by looking at the 52-week high list and pay very close attention during earnings season. Because a lot of these stocks, based on my research, 60% of the stocks that I've shown you on the previous slide, actually all of those stocks they broke out on earnings. From my research, 60% of monster stocks break out on earnings. The other 20% is because of better than expected news on what earnings are gonna be. And then 20% are just contracts and other reasons that might improve the business fundamentals. But we could say that 80% has to do with earnings release and press releases on the fundamentals of the business improving. So these are very important factors to account for and pay attention to when you're screening and finding potential stocks that are going to become monster stocks. So here, let's pull up our chart and let's look more carefully at the details of Square, okay? Remember I said look for stocks that are increasing on a daily basis and also look at the volume. Here it is. So Square, when it broke out on earnings, move this here. Here it is. So see what I mean? So the stock, when they reported earnings, was up, I believe, over 15% from one day to the next. You can see it here. This was due to better than expected earnings, strong fundamentals, strong sales growth, strong earnings growth, and a higher outlook for the next year or two to come. Also, look at the amount of volume increase. This was 40, let's see here, if we actually apply the chart, 43.9 million. I mean, take out your calculator and do the math. 40, let's just round to, let's say 43 times 17, what is that? Let's see. Here, let me just do the math right here. Let me pull out my calculator so that you can mean what I mean by this stuff. So 43 times 17, that's 7. So you're looking at $730 million of shares or transaction was traded on that day. Do you think that's your Aunt Sally or your regular mom and pop buying on the corner in their retail account? Of course not. Absolutely not. These are large mutual funds. These are the Fidelities, the Vanguards, large hedge funds that have analysts that really understand the fundamentals of the business, the economics, and they're placing a large bet that this stock over the next months to come will outperform the general market because the fundamentals of the business are strong. And that's what this represents right here. Not just that, if you understand technical analysis, you understand support and resistance. This stock on this particular day was breaking their all-time highs. They were breaking resistance. If I switch here from a daily to a weekly chart, it'll be so much more clear. You see it right here? There it is. See here? They did an IPO back in November of 2015. The stock stayed there for about a year. And then in February of 2017, better than expected earnings. They break out to all-time highs. And then the months that follows, look what happened to the stock. Just continue to increase. See that? You over here, obviously, this is an expected pullback correction. Maybe gives you another opportunity to buy it, provided that the fundamentals are strong. Okay, see, let's continue to extend this. Look at this. It just keeps going up. So now you can put into perspective, when I show it to you visually, look for stocks that are breaking to 52-week highs with volume on strong earnings. That's what you see right here. Okay, and look at the volume. I mean, let me pull this up. On that date, look at that volume. If we see it, this is now on a weekly, 78 million shares traded that week. At an average price, let's see, what was the average price of during this time? If we take that, at about 17, we could say $17. So 78, right? Let's pull up our calculator. 78 times 17, wow. Folks, that was about $1.3 billion that was invested in Square back in February of 2017. Yep, the week of February 24th, 2017. Up here, I'm displaying the earnings growth. On 2017, sales were down, okay, but then look at the earnings growth, 153%. But when you look out 12 to 24 months, look at sales, increased 60%. Then in 2019, projection was 43%, and then look at the earnings growth, okay? And institutional investors knew this, and then they're holding on to the stock for, well, these guys hanging on to it probably for 2 years. You might see this big volume down there right here. This is also on earnings. They missed a quarter. But if the fundamentals are still strong, this gives you an opportunity to buy it back, okay? So there's other more technical patterns here, but I'm trying to simplify this process so that you can learn it and then apply it to current stocks today that might show these characteristics. Let's look at Nvidia. Here's Nvidia. Let's look at the daily. Let's see if we can go as far back as from when it broke out. Multiple times. Let's go back over here. See here on February 12, 2016, right here, it broke out with higher than expected volume. This again was on earnings. So it did it here. And it also gives you another opportunity or another heads up the same year, but in May 13. I mean, this sticks out like a sore thumb. Look at the volume, as high as 52 million, and it went from 36 to almost $41 the next day. Why? Because of stronger than expected earnings. Now, the fundamentals for Nvidia had to do with their chip and the new supercomputer. I believe that they were building a computer that allowed deep level of data analytics, and their computer was also being used in some of the Tesla vehicles to process all the information to allow autonomous or artificial intelligence to perhaps do its calculation. Nvidia was creating that computer type, so that was one. The other thing that they were doing was their graphic card for gaming. That was another segment of the business that was also growing rather rapidly because of the rise of EA Sports competition with gaming, and it was really getting to a level that is very competitive. So there was a lot of demand for their graphic cards. And then they had also applications from graphics and designing. So all of the segments of their business was really firing on all cylinders. And you got to see it here during the quarters when they were reporting quarterly reports. Better than expected earnings. So if we change this to a weekly, okay, you can see right here, I mean, look at the volume. That week, volume was 92 million. The stock went to as high as $41. So you could say that the average purchase price at this time, let's say it was $39. And 92 million shares were traded. So the math on this, well, 92.8 to be exact, times, and if we round here, let's just say the average purchase price was around $38 by institutional investor. Wow. That's $3.5 billion that was poured into this stock the week of May 13th of 2016. Okay? $3.5 billion. And also, this is right around its all-time highs. Look here. Look here. Right around its all-time highs. All-time high was $39.95, give or take. If we draw a level of resistance there, see here, it breaks it with volume, and then look what happens after that. The stock just continued hedging higher. 110, then towards the end of 2017, it just continued moving higher. Monster move, okay? So it gave you clues, it gave you signals before the stock double, triple, and quadruple when they reported better than expected earnings during the month of May. Now you're beginning to see from a visual standpoint why earnings are important, especially stocks that are breaking to 52-week high, and more importantly, with volume. Follow the money, because ultimately it's really large institutional investors with more information, more research than you and I are making big bets. So you want to be with the big players as well. And of course, and do your own homework, do your own research so that you can see what they're also seeing. And you can keep going deeper and deeper into assessing the business, the market share, the fundamentals, how much revenue they're generating for each one of their products, competitive landscape. You could even buy one of their products to test it yourself, right? Very, very important. Now let's look at Lulu. Here's Lulu. Same identical setup with Lulu. Here it is. Let's first look at a daily. I mean, and this actually gave you many opportunities before they even hit their all-time highs. Here it is. Can you see it? Take a couple of seconds. Actually, before I even draw it, can you see it? Can you see where is the volume increase? Can you identify where were the earnings announcement? Yeah, it's right clear here. You see one right here, this gap. You see another one over here, this major gap with volume. And if you wait for 52-week highs, it was right here, around $85. So you had three opportunities or three separate clues where institutional investors were accumulating shares and they have better than expected earnings results. So on this day, which was March 28, 2018, the stock broke to an all-time highs along with higher than expected volume because of better than expected earnings. They beat Wall Street expectations. If we switch the chart to a weekly time frame, looks a lot more clear here. See here, 52-week high. This is where I have my resistance horizontal line graph. You see it? You see this week with the volume. If I go further back, you can see it. The stock never traded up to that point, but then it breaks. And look what happens after that. Just continues higher from there. We had a pullback, but then it resumes. It's uptrend. Why? Because of strong fundamentals. Study these charts. Folks, I have a database of over 100 of these stocks that I've studied over the last decade. And a lot of my trading strategies, my philosophy derives from me studying all of these stocks. And I'm simplifying this process so that you can also learn it and accelerate your learning curve and increase your chances of finding stock like this so that you can have better than average performance in your portfolio. Now, from a risk management standpoint, from an execution standpoint, that's a whole nother picture. But here's what I'll say about that. Don't put no more, if you're new at this, don't put no more than 10 or 15% of your portfolio in one idea, because not all of them are gonna work. We're just increasing our chances of being correct here. So do not put no more than 10 or maybe 15% in each one of these ideas if you're new to trading or if you are a new investor. Number two, make sure you limit your downside, because nothing in this game is 100% accurate, okay? Some of the best traders out there are right 50% of the time, which means the other 50% you're gonna be wrong. And psychologically, mentally, that is an intellectual blow to your homework, to your analysis, and you have to be okay with being wrong. It's just part of the game. You have to be okay with being wrong. But what's more important when you're wrong is limiting your downside, protecting your capital. So if you buy a stock, let's say at $100, and if the stock goes down to $90, get out, non-negotiable. You gave it a little bit of wiggle room, you're out, because chances are, if it goes down to 90, it can be the slippery slope for the stock going to 80, 70, 60, 50. It has happened, and I've seen it over and over and over. So you want to protect your downside. And then the upside, the ones that are correct, they're going to take care of the sound, because they're going to continue to go up over the next months to come. And that's where you get these major moves. So you also need to be disciplined in holding these positions and believing in your trades. And the only way you're going to believe in them is if you gain confidence. And the only way you're going to get confidence is by studying these charts and studying the markets over and over and over, because these patterns repeat themselves. Okay? So this is with Lulu, and you see it right here. Look at the sales growth, 14%, 13%, 23%. This is in an industry, retail, that is declining, that is dying. Take a look at Macy's. Let's compare Lulu to Macy's. Macy's is a little bit different business model, right? But look at Macy's. It's a dying business, right? Let's look at, I think Abercrombie & Fitch is one. Look at this. From 2018, $30, now it's at $15. Well, if we maximize, $11. This is the dying business. What are we at? Express. Look at this one. Okay, so you could see that in the entire retail space, brick and mortar apparel has been declining, because more people are buying online, and maybe with fashion is changing, trends are always different. But when you see Lulu, what have they done? What's so different from Lulu than your traditional apparel business? Study the fundamentals. Look at the experience. Look at how they're integrating yoga classes, healthier style of living, working out clothes, but they creating an experience that other traditional retail businesses don't have. And that was one of the reasons why revenues is actually declining in a business that was dying, in an industry that was being faced heavily by the online retail, by the online e-commerce sector. So you need to also understand the fundamentals and the dynamics of the entire industry. The clues are in the charts and in earnings when they're breaking out during that time. Then it's up to you to dig in deeper into the analysis and research it. So we went over Lulu, we went over Square, and we went over Nvidia. Pay close attention to those charts. We replay this video and write down a list of what I'm saying, and then try to apply it on previous stocks that have outperformed. On a spreadsheet, go to the SEC filings, look at the last 3 years of revenue growth, and plot it down on a spreadsheet, and then just study the patterns over and over and over. That will give you the confidence to identify current stocks. So with that being said, in our next slide here, we're gonna look at some stocks that have met those characteristics and how they have performed year to date. So we are going to apply what we've identified: breaking out on earnings, 52-week highs, strong revenue growth, strong earnings growth, innovative product in a new economy. These are the stocks that are representing that right now. So you see the first 4 stocks Zoom, Teladoc, Shopify, and Tesla. These are alpha stocks. Ones that are emerging right now from the last quarter, and there's many of them, but these are two that I just wanted to share with you in this lecture. Tulio and Logitech. Let's go through each and every one of these stocks so that you can see the patterns from a technical standpoint, and then of course back it up with the fundamentals. We have other lectures in our YouTube channel analyzing Teladoc and Zoom. Go back, watch those lectures, see how we perform our three-step process of performing due diligence, performing our technical, applying technical skills to come up with price targets, and then formulate an investment thesis. A wealth of information and knowledge in there. So I highly recommend that you watch those lectures. So let's look at these stocks by applying our chart. So the first one will be Zoom. Let me fast forward this. Okay, here's Zoom on a weekly basis. Let me erase these drawings here just to make it more clear. There we go. Okay, on a daily time frame. Let's go back to the beginning of the year. Okay, the beginning of the year. Here it is. This was on February 3rd. Look at the big increase in the stock price. Look at the big increase in volume. This was due to the coronavirus and more businesses adapting their service, and they saw an increase in their user base. That was right here, okay? So that was the big heads up. If you zoom out and look at historically the stock price prior to that level, you can see that the highest all-time high was around 100 and, well, if we want to be exact, 107. So let's draw this resistance point here with our horizontal line. Okay, this is the all-time high. If we fast forward, you can see that they actually broke that all-time high around February when the coronavirus really started to spread, and you begin to see a lockdown of the US economy, business closing, the government mandating a stay-at-home order. You begin to see the breakout from all-time highs. And look at the volume bars here, increasing as well. Now, if I fast forward, look where the stock is at now. It's at 215. If we change this to a weekly time frame, you could see that the first signal was when it broke out in February. But look at the weekly. Let me move this back more. Right here. Look at that. Sticks out like a sore thumb. How many shares were acquired that week? 33.6 million. And we can say an average price of $85. Let's do the math. $85 times 33.6. Folks, that's about $2.8 billion that went to this stock. About what was it again? 2.8? 85 times, what was it again? 33. Yeah, 2.8 billion. Follow the money. And from there, look at the stock keeps going higher. Now, is it going to continue higher? From my analysis, it can, because it's a clear winner. But there are some analysts out there that don't believe that they are at a tipping point yet, and a lot of the free users, they're not going to be able to monetize it. So only time will see. They also reported the most recent quarter stronger than expected. Management raised guidance for this year. So there is a strong demand for the stock right now, and I wouldn't chase it at this level. I would wait for a pullback before I buy it. If you want to know more, go back and look at the Zoom stock analysis lecture. I was very detailed on the game action plan. All right, let's look at another stock. Let's look at Teladoc. Let me erase all of these drawings. This was part of the previous lecture that I did on Teladoc. So let's just delete all of them. Okay, now let's go back to the beginning of the year. Here it is, breaking out with volume. Where was the all-time highs? Let's go back a little bit more in history. Here's the all-time highs. It's the same setup. Look at that, breaking all-time highs with volume. Let's look at weekly. Same setup as the other stocks that I've been showing you. Are you starting to recognize the pattern? Are you starting to see the similarities, and then after that, the rest is history. So they break out around $90, and in a 6-month time frame, the stock more than doubles. Now, are the fundamentals strong enough for this stock to continue moving higher? Maybe do you hit 200, 300, 400? I currently right now have a $233 price target on this stock, but I do have stops in it from an execution standpoint. Go back, look at the Teladoc Health stock analysis lecture, do your own homework, and rest assured that they're not always going to play out this way. There's a lot of stocks that break out, but they also fail, and they come right back down. So this is why I say they're not always going to work. I can show you a list of stocks also that fail, but from my own analysis and my own experience, this is one of the best way to find stocks that are going to continue to double and triple, where big institutional investors are flowing and putting capital behind the name and placing these bets. Okay, Shopify, another stock. Let's look at Shopify. I mean, Shopify is at 700 right here. Shopify first came in my radar, I believe it was in 2017, at around $40 a share. And right now, it's at $742. So you may ask, gee, Luis, how? The same process, folks, the same product. Let's go back. Oh, here it is, and I drew it. Let's go back in time. Breaking out to all-time highs, breaking resistance with what? Volume. Now you begin to see why this is very effective, and you can use it and apply it on a daily basis to find stocks that have the potential to double, triple, and if the fundamentals and the business model is really strong, these are stocks that for the next 5 or 10 years can be up 10 times, like an Amazon, like a Google, like a Netflix, like a Shopify. So let's zoom out a little bit more. Look at this. Prior to that day, which was January 2017, let's go back. Look here. Nothing over here. All-time highs. And then from there, the rest is history. Look at that. Just moving higher and higher and higher. So you see that? Look at the earnings, the fundamentals. Sales growth in 2017, up 73%. Earnings growth in 2018, up 59%, and so on. So you are now beginning to see why earnings and growth matters. And also stocks that are breaking all-time highs with volume, very, very important. All right. I also mentioned Tesla. Let's look at Tesla. And for the most part, you know, there's a lot of investors on Wall Street, fundamental-based research that were short the stock. They didn't believe in the business model. Tesla was burning through a lot of cash. From a free cash flow standpoint, it was negative. So they needed a lot of debt and equity financing in order to run their business. So there was a lot of investors placing shorts and betting against Tesla. But again, Tesla came in and they had a better than expected quarter right here. Look at that. You see the volume? Let's go back before they did their nice move. Here it is. Breakout. Better than expected volume. Look at all these shares. Okay? If we zoom out and look at all-time high, where was the all-time highs? Here's all-time highs. Around 386. And then from there, because you had the volume behind it, better than expected earnings, a stronger outlook, the rest is history. Look at this. This went almost to $1,000. Right? But then, I mean, now you're getting into very aggressive points. And of course, the coronavirus was a big influence on why the stock gave back some of these gains rapidly, but it gives you another opportunity to buy it back. Okay? Now, if we go back to the beginning years of Tesla, you could have also bought it at a much lower price. Let's see. It doesn't show here. Let's go on the weekly. Here it is. Wow, we're going back to 2013. Oh, here, this is their all-time highs. Wow, we're going back a long time. Here, you see it? They break over $40 with volume. See that? And this was better than expected earnings on that during this time. And then from there, the stock just wow, this was a monster move in a very short period of time. Okay? So just study these patterns, and you're gonna realize that a lot of it has to do with strong fundamentals. A lot of it has to do with institutional sponsorship. And in a lot of cases, these stocks are new. They have done an IPO. They've been in the market for less than 10 years. And they're innovative. They're shaping our economy with a new product and service. Therefore, maybe creating a viable business that will be around for the next 20, 30 years. And we will all grow up with this brand as being part of our generation. Just the same way our parents and great-grandparents grew up with the airline industry. When the airline industry was new and it was growing, a lot of those companies had charts like this. Also, if you go back in the early 1900s, the railroad companies were also being the market leaders of that time. Same thing with energy, with oil and energy stocks. Well, today, it's the Teslas, the Googles, the Amazons, the Facebook, the Microsoft. So you have to understand these things, okay? And see that the scenario plays over and over again. So it leads me now to my next point, which what are current stocks that show these characteristics? And I pointed out two of them in our slides. One was Tulio. You see it right here. Tulio breaking out all-time highs with volume. See that right here? With volume. Now, it's your job to do your homework on Tulio. It's your job to see how fast is revenue projected to grow. It's your job to see what the fundamentals of the business are. Do they have a better product or service than anyone else out there? And then come up with your own analysis on whether or not this stock will double from here. I've done my stock analysis lectures. I've given you the methodologies. I've given you how to come up with price target. So it's your responsibility to do the homework and analysis. And you can see the characteristics. Very similar. Let's look at a daily. Look at look at it right there. Look at it right there. If this stock breaks this resistance up here, because right now it's just trading in this range, if we break to the upside from 210, is that the beginning of a major move where the stock might go to 250, 300, 350, or even maybe $400? Pay attention to this stock. Is it going to play out that way? Maybe. Might it come back down and give all these gains? Maybe. Remember, the best ideas don't work all the time. You might have a 50-50 probability outcome of these things working out, but at least you want to increase your chances of getting it correct by backing it up with your research and your fundamentals. And also have a stop loss in place to minimize your downside. It's kind of like an insurance policy, right? One, don't put no more than 10 or 15%. If you're new at this, if you're more advanced and you have experience, then I leave that up to you. But the one thing you cannot negotiate is having stop, because it's your insurance policy from protecting your entire portfolio and not blowing up your entire account on something like this, okay, if it doesn't work. So this is one of the stocks that is showing those current characteristics right now. Another one is Logitech. See here, breaking with volume. If we go back, all-time highs weekly, here it is. Breaking all-time highs, with volume, better than expected earnings. Now, if you look at the fundamentals, Logitech, what do? They make video devices. They make video cameras, mouse, and other electronic devices. But more importantly, on the camera side, which is creating a higher demand for these cameras. Why? Because people are staying at home. They're communicating and they're interacting through Zoom and video conferencing. This is becoming now more ingrained into our day-to-day lives. And it's going to leave a legacy. Even universities are conducting their lectures online. Professors, they have to buy a camera. What is the brand of choice? In a lot of cases, it's Logitech. So the chart is supported with the fundamentals, which means higher revenue growth, higher earnings, higher cash flows, which yields a higher stock price, with a higher intrinsic value if you do your valuation analysis and apply your own methodology. So I've given you two stocks that fit the criteria of alpha stocks, and there's many other stocks right now in our current economy that are displaying the same technical chart and pattern. It's your job to study it, do your own homework, and slowly as you gain more experience, then you can tweak it a little bit. Then you can add your own edge from your own homework and analysis. You might identify things that I may not have identified, but at least I'm sharing with you my work, my study over the last decade, so that it accelerates your learning curve, and hopefully you can gain some benefit and value from this. All right. So let's see here. I have a couple of questions. Let me check out and perhaps answer some of these questions. Yes, number one, is this record? Yes, it's recorded. It's going to be uploaded on our YouTube channel. And if you subscribe, you're going to get it and turn on the notification. You're going to get an alert email as soon as we upload this video. So yes, it's going to be in our YouTube channel. Number two, so don't buy, Adi, if you're asking me that question, you already know the answer. Here, for those of you that are watching. So don't buy stocks like Hertz? Absolutely. I cringe. What here? What is their ticker symbol? HRTZ, I think, for Hertz. Hertz, here. You gotta, look at this. You gotta be kidding. You gotta be kidding me. Listen, I came across also an article that they got the approval to issue $1 billion worth of shares. And this is a company that is going to go bankrupt. Who are they selling that $1 billion to? Who's taking on those shares? Is it another institutional investor that is going to take their shares into the bankruptcy proceedings and then renegotiate a new capital structure? Or are they dumping 1 million shares into the market to regular retail investor? I mean, I've seen articles that individuals with Robinhood accounts are basically pumping and dumping this stock. Guys, this is very speculative. You might say, hey, Luis, yes, look, it went from $1 to $5. I double, triple my money. Okay, there's good for you. But if you do that same trade over an extended period of time, 100 times, chances are that you're going to blow up your account because you don't understand the risk involved with this. This is highly speculative. These are the things that I used to do in my early days when I was a college student. Sometimes I got it right. When I got it wrong, I blew up my account because I didn't understood risk management. I didn't understood stop loss. I didn't understood portfolio weight, diversification, how much to place in any one single investment idea. I didn't understand any of this stuff. And this was just purely gambling. So you have my answer right there. I wouldn't buy this stuff. Oh man, there's so many good names out there that if you really want to become an investor and be successful at this, not overnight. I mean, this is not a get rich quick scheme. Absolutely, guys, this takes a lot of work. Nothing worthwhile is going to achieve success overnight. Because in this type of environment, or when you're investing, you're competing with some of the world's smartest investors that have been doing it for decades. And one thing that they understand is risk management. They understand not all trades are going to work. They understand that you need research behind your ideas. They understand market dynamics and momentum. And these guys have millions of dollars that when they place a bet, it moves the stock price. So you think that the smartest investors are actually playing around with penny stocks where when they allocate 5% of their portfolio is more than the entire value of this company? Of course not. So why am I going to play this game if they're not playing that game? And I just giving you good examples of stocks that double and triple with really good fundamentals. But of course, you need to understand as well when to buy right, when to take profits, and that's a little bit more complex, and you can apply technical analysis because you're not going to own a stock always. You could have bought it at $40. You could have probably taken profits at $150, at $200, but you're never going to hold something forever and sit during these major moves. That's another skill set, and you need to combine that with technical analysis. You need to have a profit target taking strategy or plan because you can definitely lose half of your gains. And what it does to you mentally, psychologically, it does more harm than good. Even though you make money, even though you could still be up 100% or 200%, the psychological harm that it has when you hold through these declines, it can really mess you up. It can destroy your confidence. You can begin to look at other strategies. You can begin to execute and trade and look at other things that you shouldn't be looking at because you have a big loss. And losses have more harm psychologically than anything else out there. How do I know that? Because I went through it in my earlier years. I've gone through that process. And if it doesn't resonate with you, if you don't understand it, it's because you haven't gone through that yourself, right? For those of you that have the experience, you know what I mean. For those of you that don't, then it's a huge advantage for you, because hopefully you can develop the right habits. You can apply what I'm teaching you and do not make those mistakes that new investors make when they don't have the rules, the disciplines, and the guidelines. Some of you will do it the right way, some of you won't, and it just has to do with your personality. All right? All right, folks, any other questions? Is there a stock that perhaps you may want me to take a quick look at and give you a technical analysis perspective? Okay, let's see here. No? All right, great. So with all of this being said, to summarize, pay close attention to the company's revenue and earnings growth. Look at their market share, their product. Are they innovative? Is it part of the new economy? Also, how do you identify stocks that are breaking out? Pay close attention on earnings season. Make sure it has volume, 52-week high. You can do a very simple Google search to find platforms like NASDAQ, Yahoo Finance, where they can give you that data and that information. And on a weekly basis, you can kind of create your own list and then just filter it out based on some of the filters and criteria that I've given you. So is this an exact science? Absolutely not. The science part, you can combine it, but you also apply an art form to all of this. I'm just sharing you part of my work that I've researched and done over the last decade, so that it accelerates your learning curve. And if you can gain something out of this and apply it straight at the end of this session, then we all win. You win, I win. I think I've done my job as an instructor. So with that being said, I'll end the session here. Enjoy, stay safe, and I'll see you in the next one. Take care.